Good morning, everybody. Welcome to the Flow Show. It's Wednesday, the 11th of October. Just me, myself, and I today, as the K-Man is off back to his native land in Belgium. So we shall get right into it. Going to just kick off with a little bit of data out of Japan overnight, if I can find it. Where is it? No, I can't find it. There it is. Machine tool orders year on year down 11.2%. So another negative number there coming in year on year. So a bit of softness still in the manufacturing sector there. The Tankan survey coming in unchanged at 4. Nothing to write home about there either. Over in Eurozone, German CPI for September final numbers confirmed everything we saw in the flash. 4.3 in the HICP, 4.5 in the core number as well. While we're at the ECB, they released a survey, consumer sentiment survey. CPI for the next 12 months expectations edged up to 3.5% from 3.4%. 3-year inflation expectations up a pip as well to 2.5% versus 2.4%. That's the second month running those have gone higher. On the income front, there was a touch of an improvement as well. Incomes over the next 12 months, those that see it higher coming in at 1.2% versus 1.1% previously. On the spending front, though, it turned a little bit softer expectations for spending over the next 12 months, 6.4% versus 6.7% previously. So the ECB seeing a bit of stickiness. That will certainly, or that will likely get some comments out from ECB bods, just repeating the rhetoric that the job's not done yet, and that inflation still remains far from victory. That's borne out by some of the speakers. ECB's Holtzman, one of the big hawks, says more rate hikes are still possible if new shocks emerge. ECB's not. Another hawk says restrictive policies will be needed for some time, but policy is in a good place now. We stand ready to adjust rates further if disinflation is stalled. The ECB apparently is looking closely at banks and their commercial real estate loans. They want to hear some details of structures and what's going on there. So they've potentially flagged a possible stress point in bank lending in the real estate sector. Doesn't mean there's anything impending right now, but one could level the claim there's no smoke without fire. So they are definitely seeing something happening there. Over to the Fed, and well, there's been other floodgates going on with this thing in Marrakesh. Bostic, sticking to his usual script, doesn't see the need for more rate hikes. Fed's daily, she was the hawk turned a bit dovish, still sitting in the bit in a neutral camp-ish, saying we have more work to do. Inflation is still high, but if bond yields are tight, it could be the equivalent to another rate hike. Maybe the Fed doesn't need to do as much if the market has tightened. Another hawk, Kashkari, says inflation is headed down, and the reason for a rise in the 10-year yield is a bit perplexing. One story is the higher growth expectations. Maybe a bit of a fairy tale, that story, but that's what he's thinking anyway. The yield surge may also reflect rising US debt issuance. That's more likely to be the case. We may have to raise rates further if the economy is more resilient. It's possible that higher bond yields could leave less for the Fed to do. So now you're seeing a bit of a theme coming out from these guys and girls that the level of yields is potentially doing the job of tightening for the Fed, which, if that continues, will keep that potential last hike sitting in the back pocket. On the yield front, we had a 3-year auction overnight. Softer demand, really. The bid to cover was 2.56 versus 2.75 prior. That's a little bit soft. The sort of 6 month or 6 auction average is 2.79 times on the bid to cover. So all numbers are coming in a little bit softer. One swallow does not make a summer, so we have further auctions coming as well, but maybe some worries just creeping in about the demand side for these auctions coming up, especially with the US issuing more and more to cover some of those black holes in their financing. So we need to keep a further eye on those. Over in geopolitics, and a lot going on in gas at the moment. We had that story yesterday about Finland probing their gas leak, and they are largely thinking it's an act of sabotage, from which NATO's Stoltenberg came out saying that he sees a serious response if the Baltic pipe leak was an attack. Israel has stopped gas supplies, and that's affected exports out of Egypt, or potentially going to cause a problem for exports out of Egypt, according to the IEA. That's got Italy in a bit of a hop because they take a lot of gas from that area, and they are trying to diversify away from Russian gas, and this was one of their outlets or inlets, whichever way you want to call it. So that might put pressure on Italy, gas supplies and whatnot. And, you know, tinfoil hat on, all this gas stuff is happening as we're edging towards winter. I'll leave you to get on with the conspiracy theories on that, but rather than air my thoughts publicly, we can see what that means to geopolitics and the winter to come. Anyway, moving on. I noted yesterday that Amazon were going to be raising wages in the UK for its workers. That's gone down like a lead balloon, apparently, because workers at a site in the north of England are going to be striking for 4 days next month, which will include the Black Friday period, according to the union representing those workers. So folks are still not happy with pay and conditions there. Right. That's about it I've got from the headlines. The only other thing was RBA's Kent was out, but he just repeated pretty much the last RBA statement that some further tightening of policy may be required. So it's been a bit quiet on the headline front. We have had all these central bank wafflers, but no one's really given us anything new or to get our teeth stuck into. So we're seeing some pretty tepid price action at the moment. What we need to look forward to, hopefully look forward to, is the PPI data to come. Surprisingly, it's coming before the CPI number. Usually it happens after, but this might be a little bit of an appetizer for that CPI data. Certainly with the market not doing an awful lot right now on anything, this data has the potential to spark some life into things if we get some big variations. So headline PPI year on expected to come in unchanged on the last month at 1.6%. The all-important core number is expected to gain a pip to 2.3%. Then you have all the other different metrics. So for this one, I think, again, it's going to be size of variation, if at all we see that. So, you know, in normal times when things are, you know, running along calmly, something, you know, 2 pips either side is usually your metric. But as we're in some far volatile times, we're probably going to look, somewhere 3 to 4 to 5 pip difference to bring a big market reaction. So if the core PPI comes in hotter, say 2.6, 2.7%, then you're going to see the dollar move on that. Same with the PPI there. So what are we going to expect from these numbers? Well, as I said, it's going to be a lead into the CPI tomorrow. CPI is expected to fall back a pip on the headline number, and also on the core number. I'll just check my numbers again. give me a second. The core is expected to fall 2 pips to 4.1%. So hot PPI here is going to raise expectations for maybe more stickiness in the CPI numbers. You can't always use it as a direct comparison because PPI can lag CPI by a bit. But keep an eye. If we get hot numbers in both PPI numbers, then the market's going to raise expectations for CPI tomorrow naturally. That's likely to mean a bit of a dollar bid and maybe yields pushing back up again. Conversely, on the other side, if we get softer numbers, let's say, the headlines coming in around 1.1, 1.2%, the core 2% or less than that, then we're going to be thinking soft landing, inflation's coming back down. The Fed won't have to do much more in terms of that last rate hike. So that's for the numbers. Now, what we've got today is a little bit of a move in yields, and it's pretty much across the board. But if we look at some of the prices, US 10s, we've broken down below the 2.7-ish area. It's some people looking at 2.68, 69, 2.71. I'm just calling it 4.7. So that was an area that we found resistance on the way up. We found support. Now it's resistance again. So now this is more and more obviously looking like a bit of a double top. Now, why is the reason why yields are coming down? Well, maybe because it's finished going up. There's been a pretty incessant move in yields as the market came around to the conclusion of the Fed staying higher for longer. Could be seen as a little bit of a last hurrah since that last FOMC meeting where we got this quite strong move. In my opinion, we've priced it now. The market's priced it now. So there's nothing that really supports yields going higher in terms of the market repricing what it thinks its expectations are. So if you haven't got that bid, the only other way is down. Does that mean we're going all the way back down? Not necessarily. The data's still very strong, but the fact that we've had that strong data and yields and in some aspects the dollar haven't responded as it was in this move, then we are finding ourselves a bit more balanced. So a bit like a lot of markets, a lot of pairs, we're in that sort of treading water stage, moving into that what next zone as well. As mentioned, it's a story across the yield space. German 10s, Bunds, finding a bit of a bid. Apparently there was some big orders, or a big order went through this morning. Trips and buy stops. So it's all playing into this generalised yield move that we're seeing. Now, maybe surprisingly, this yield move, particularly in the 10s, isn't bringing as much dollar weakness as one might expect. Euro dollar still struggling at this, 106, 10, 15, whatever you want to call it. We're still struggling around here. We can't make a decisive break above this area and hold it. Dips this morning are fairly limited though. Let's just bring it into a shorter time frame. So yesterday, I mentioned that this failure here would need to hold around 75.80. Yeah, well, we got to what, 72s before bouncing. Then it made that new high. Then we've pulled back. So we're trying to keep above this 106 area, but it's just not holding either. So it's not very clean. We had a try this morning on those yield moves. It didn't last. We did make a new high, so it keeps the momentum going. And the pullback has, as I said, been pretty shallow, but we're just not making a decisive move. On balance, just looking at this price action, one would think that maybe we are going to move higher. But it's a bit of a seesaw at the moment. Until we sort of see a proper hold up around 610, 615, it's still all in the balance. Same thing, dollar yen, although that's still a bit more out on a limb, one should say. The highs are getting a bit lower. but we're still finding decent bids. 148, 40, 50 once again showing up, whereas it didn't in past times. It's been a bit on and off switch. So this is just starting to look like it might want to be moving a bit lower. But again, that can all change. A really hot PPI data later, we might be back up through 149. I'll be watching that closely because I think for now that I still think for now that rally sellers are going to have the upper hand in this one, at least in the short term. I'm still really got my buses parked 150, 147, but I've not done anything so far this week, and I might be tempted if we get a decent pop in dollar yen on hot PPI numbers just to try a little short in that one. Similar story. It really is a similar story all over the place. It's a tough environment to trade right now. Well, for me it is anyway. I know plenty of you guys and girls will be scalping away, and good luck to you. But for me, I don't like getting involved in this sort of mess. I don't like trading in a 20 pip range in euro dollar. I either want to see something significant happen, or I'll just sit back and wait for my levels. So that's what I'm doing now. Gavin, yeah, TTF and UK gas up 25% this week. Yeah, I looked at that this morning. A lot of people look at nat gas, obviously, in the US markets, and it's pretty much a similar picture there. In the others, as you can see, we've had a bit of a takeoff on all this gas headlines suddenly hitting the news. As I said, typically we're coming into winter, so you know, there's that to factor in as well. But if there's going to be problems there, then we might be starting to see prices going back up, which is obviously going to then bring the inflation picture, adding to oil inflation pressures that we've all seen of late. So yeah, just one to keep an eye on that one. Ali, he's jobbing away, looking at dollar CAD. Long at 135.95. Let's have a look at old dollar CAD. Right, so this is one again. You know, I'm more bearish the pair, but I'd like better levels to sell it rather than try and sell it down here. Again, another one to look at for the PPI. If we get a bit of a rocket up. 136.50, it might bring me out Michelle a bit to try a bit of a short into that one. But short long up here, so okay, take profit 136.75. Yeah, fair enough. Quite 134. So you're giving yourself you're going quite wide on your trades at the moment, Ali. Looking for quite high profit target and quite a low stop loss on that one. So. Yeah, I mean, that will keep it well within the range. Got a bit of a zone down here, so that's one area to look at. It didn't hold when we had all that move at the end of September, that month-end stuff. But that might show up on a secondary move down here while we don't have that influence. But yeah, I hope you make your money, Ali. But unfortunately, I'm going to be on the other side if we see a rally up in that one. So if you get up there, well, I'll probably be adding to shorts, and then we can both make money. How about that? Yeah, Bran, this Israel stuff is ticking over. I think our focus and just taking it from a trading perspective on this stuff is whether others are going to get dragged into it. You know, it's stretching out to Egypt, Russia, and Iran foreign ministers had a telephone call or conversation yesterday. Everyone's watching from the sidelines, and it has raised the prospect of, you know, people stepping in. You know, we've had the Kremlin out with some comments earlier saying that they're watching what's happening over there. So really, from a market perspective, it's whether things spread a bit wider, whether some of the outside actors, US, Russia, China, get more involved in what's going on. Only then will we start to see the market sitting up and taking a bit more notice. So let's hope it doesn't go that way. Hey, Alex, Morning to you, mate. Yeah, let's have a quick look at oil. Doesn't seem like it wants to get back to those highs, but again, a little bit of what next here. I think it's not going down anymore because of the potential for the geopolitical risk in the region, although that's not it's not a huge risk right now, but perhaps the market's just a bit cautious about it. So we had the move up, got above an area I was looking at, 93s, 94s, poked its nose above, then came back down, then poked its nose below the lower levels, and now it's just another one treading water. Again, it's making it very difficult for a lot of traders, you know, sitting there. This is one of those times where, think of it like a bit of practice, a bit of training on patience. Okay, if you're not got your levels anywhere near what the price action is doing, if you don't want to be trading in, you know, a buck and a half range all day long, then this is when you need to practice your patience. You know, don't look to trace trades. Don't get yourself stuck in the middle of something silly just because you haven't traded. As I say, I've not traded a week so far, and right now I've no inclination to do so. And yes, it does get frustrating because we're here to make money, we're here to trade, but you've just got to resist the urge to trade for the sake of trading, because that's when you lose money. That's when you do something silly. I'd rather do nothing. You know, go do some research, go and paint a wall, or whatever you guys do at home. Go and walk the dog. I know one of our traders just got a new dog. Hopefully that's not because he's bored trading, but yeah, that will keep him busy. So yeah, you know, read up on things. You know, find out if if there's subjects in the market you're not sure about, go and read up on it. Do put your time to good use. If you don't trade, you don't trade. I'd rather not do it. Yeah, Brian. Trading for the sake of trading, it's not a good thing to do. Go for a walk. Right, just to look in, have a brief look around some of the other pairs and assets. Gold continues to tick up a little bit. Got a bit of that intermediate level around here, 1871s. The bigger level for me is this 1885, which marked has been a bit of a range bottom. That's an area that I tried buying longs and got taken to the cleaners on. So they need to see if we get up there, that area in the broken fib, is it going to hold up there as resistance? Again, it might set up for a bit of a range play between 1800 and 1885, 1890, maybe call it 1900. So if you've been long off the bottom here, you're sailing pretty. You know, bring your trailer stop up if you're running one, you know, edge it up, take some profits off if you can. I know that's easier for those of us not in the US to take partials, but you need to protect these moves. You know, if it doesn't get through 1870, what you're going to do? You know, protect yourself, get your stops in profit. So if it does suddenly pull back, at least you walk away with something if you haven't been cutting. Just looking around some of the others as well, some of the crosses that I know folks like to keep an eye on. Oh, where am I going in that? I'll look at Euro CAD. Again, a bit of a mixed picture. You know, we've had a bit of a rally, we had a bit of a dip, but now it's sitting bang in the middle. So again, another one that's really undecided what to do. Again, you can, if you're looking at trading the CAD, this is one to look at. If you want to take the dollar out the equation, stay over the PPI report. What you may find is a little bit of passover. You know, if things are picking up in inflation in the US, we've already seen that same similar impact in Canada. So you might get a little bit of a spillover on a hot number here, where, you know, if the US is getting it, Canada's going to get it. So keep an eye on this one, because you might see a bit of a gain for the CAD in some of these crosses if the US numbers are hot. Right, let's have a look. Any other questions? Throw us up other ones if you want us to have a look at, or want me to have a look at, since I'm here on my lonesome. It's a bit difficult, as I said, when all the pictures are looking precisely the same. Anise wants to look at a Kiwi, which we can certainly do, if I remember where it is. There it is. So this one's a bit close but no cigar. I know someone in our room were looking to get short up into this area up here, 50s, 60s, and came up short of getting their positions filled on that. But it's again one of these areas, you know, suddenly you hit a level that's a bit more significant. You know, we had the level here around the 59, 60s. Couldn't get through. Then we had the break, but then it washed out. So it's become a bit wishy-washy at the level. But in the last move, we have sort of held into that area, 59, 90, 60, call it. But we run into a bit of a longer term zone around 60, 50, 60, 60, and it's coming up short. This is almost a bit like euro dollar at the 106, even 15 area. You know, as soon as you hit a decent traffic area, the market says, no, we're not getting through there. You've had your fun buying it up here. Now the sellers are coming back in and saying, not so fast, you're not taking us into this area here. So you've got, again, it's a matter of context. You know, look at your trends within trends within trends. You know, we've had a big uptrend. Now we're in a downtrend. In the midst of that, we've got a short-term uptrend. Now the short-term uptrend is holding. We've broken the 50 fib already, so it suggests that you know, we're coming back into things. But then you look at this trend. What's it got to do to break this shallow move down lower that we've had all year? Well, it's got to get you know, right back up, back above the old 38.2 here, 61.45 and a half. So depends what you're doing, Anise. Are you long? Are you short? Are you trading long term? Short term? You know, let us know, and I can look at it in a bit deeper for you. But yeah, got to moving average action going on here. The 100 DMA sitting right on that 60 line as well. So again, a reason why the price has perhaps pulled up, at least on the technical side of things. Another one, again, bloody ping pong markets, I tell you. Dollar China still glued. Had the move yesterday through 728 down to 727. Today, hello, 728 again. Now we get another bounce into 30s. So the more I look at this, the more I think that maybe the officials are playing both sides of this, maybe unofficially, if you like. We know they've been stepping in, selling dollars in strong moves higher. Maybe they're just giving their banks the rope to get those back if we get dips under 728 or to 728. So it may be, as I say, they're playing both sides of the coin on this one, just to keep things stable, which is their main rhetoric. You know, they always say, the PBOC, they want the yuan to move in a stable manner. Well, it doesn't get much more stable than this. What I might do now is be a bit more confident jobbing it between 728s and 732s, at least from the short side. So adding a bit more 732s, 33s, offloading down into 29s, 28s, if not better, and just chipping away, doing a bit of jobbing in between there while keeping a core position on board. You're long Kiwi, Anise, 59.74. Okay, that's good. Let's have a look at that in a bit more detail then. So you have got a bit of margin in the trade. You're well on side, so you're in from down around here. So yeah, very nice. The trend is your friend, as we said, so it keeps going. If you get a hold back below 60, that's when you've got to be worried. So you might expect that dips to come down to this 59, 90, 60 level, because it's a bit of an on-off support and resistance point. So as long as that holds, you're right. But you need this higher level to break. So you've got a good 70, 80 pips out of it so far. I hope you're taking profit or have taken some profit and locked in your stops behind, because you don't want to be 60, 70 pips on side, not taking anything, and then something happens and you get stopped out. So in these slow markets, just take some money when it's available. Ellie, on a daily basis, listen, yields are going there, carry trade, bonds are going lows. We know yields will go higher, dollar will go higher, bonds will go lower. I want to know complete knowledge. Okay, you want to go deep in the knowledge. Okay, so you know that if yields are going up, it means bonds are being sold. Okay, so the price is going down. So people are selling. The balance is with the sellers. That's what's causing yields to go higher. You don't buy yields up. Okay, so it's markets selling bonds. Okay, and what that means is it depends on the context. It can mean different things at different times. Yields going higher can often mean, as Kashkari said, that investors feel confident in the economy of whatever economy is. You do it with the US is the easy example. So US yields going higher. If it's because investors think the economy is doing well, then they get out of safer assets like treasuries and they put their money into risk, which is why you see yields going up and stocks going up. That's a typical play you see. People are getting out of bonds because that's a safer play and getting into higher risk things like stocks. So that's the usual or one aspect, one context that you can use for that. But another context can come if investors feel that there are issues going on. Now we know the US is increasing its debt by a big chunk. It's issuing more debt, issuing more bonds. And so investors might be thinking, well, you're putting yourself in a bit of position, guys. You're looking for raising higher debt amid higher rates. It's going to be a pressure on you to repay that debt. Therefore, we're going to demand a higher interest rate from you to buy your debt. So that pushes the price of yields up as well. And that's more of a negative because then it's seen as a potential financial worry. Okay, the US is increasing its debt. How's it going to pay its debt with all high interest rates? Right, we want a premium to lend you money, Mr. Biden. So that's the other side of the coin regarding yields. Now, what happens with the dollar? Again, it can go up or it can go down depending on demand. So if investors are happy, if foreign investors are happy to buy US debt, they obviously need to buy dollars to lend to the US. So there comes your dollar demand for things like that. But in this case, as we saw with that auction last night, demand wasn't as much as it was before. Therefore, there's less dollars needed to be bought to buy those bonds. You can look at it in that instance. Therefore, the market's saying, well, no one wants to buy US bonds. Well, that's where the dollar gets sold. So it's all a level of context. I think right now there's a bit of a mix going on. There's a mix going on because the economy in the US is doing okay, but the US is also increasing its debt load. So there's a balance. In one side, you've got the positive economy, and the other side, you've got the higher debt. So what we're seeing, I think, with yields right now is that pull and push between the two. Sometimes yields are going to go up because markets, seeing the higher for longer message. So it's seeing a better economy. It's getting out of bonds and going into stocks. But on other times, we're seeing we're worried about the level of debt and the level of cost to the US. So, we're not going to give you our money. That link's probably a good one there, Gavin. Have a read of that. What does this high yield mean? People deposit and get more interest. Again, that's another aspect. You've got investors who are maybe thinking, right, well, if this is the top for interest rates and interest rates are going to go down from this point, then I'm going to buy bonds. I'm going to put my money into bonds, 4.5%, 5%, whatever, because I'm happy to sit on that. I wasn't getting that in a savings account for the last 15 years. Now I can put it in should be relatively safe asset like government bonds, and I can earn interest there rather than leaving it in my bank account. So there's all different types of investors. You've got investors who like risk, you've got investors who like yield, you've got investors who like switching from one to another, playing one yield off against another. You know, like the carry trade, borrow cheaply to park your money in somewhere you're going to earn something. There's never one force at play. The only time there's one force at play is when you get big moves like this. So you can pretty much say that this move in yields, if we just look at US 10s, was a flow of money. Okay, it was a flow of money that moved these yields. Now that flow of money stopped, and so if that flow isn't there anymore, then the market's going to drop or yields are going to drop. It's the same in everything, supply and demand in its simplicity. You know, that's why prices move. That's why euro dollar goes up. Forget technical levels, forget everything, forget moving averages, fibs, trend lines, whatever. If there's more buyers than sellers, it's going to go up. And if there's a reason why the buyers think they're on the right side, then they buy strongly, and the sellers go, well, we can't fight that, and so the price moves up. It's, you know, supply and demand is the basis of everything to do with trading. But anyway, that's hopefully a brief insight into what happens in bonds and yields and flows and investors and whatever. But yeah, while it's quiet, as I said, you know, get into some research. Investopedia is a good place to start. Do some reading up, see how markets move. But again, don't get too tied up in the correlations. You have to know what's moving something any one time. Don't just think yields down means dollar down. It doesn't always happen like that. You just take your cues from what the price does, not what you think it does. Yeah, that's a good book as well. That's more for trading. Attacking Currency Trends from my old mate Greg Michalowski, very good teacher on that. Yeah, Ali, your point, investors' division of money goes from here to there. That's what trading is. That's what's happening each and every second. You see prices move and assets move. It's people just moving money from one place to another. They think today, right, the economy is doing well, I'm going to buy stocks. They see two bits of bad data. They think, oh, no, that's not going to happen. I'm going to move out of stocks and I'm going to move it back into bonds. Every day, all it is flows, back and forth, back and forth, back and forth. And when those flows are strong in one direction, that's when you get a trend. That's the way you got to look at it. Right, so come on, guys and girls. Anything else you want me to look at? Let's get some comments up. You know, how are you finding these markets? Are you making money? Are you finding good opportunities, or are you finding it a bit slow and a bit tough, and you're getting that itch to go chasing trades and stuff? Brian, let's look at cable. I mean, you get this enough in the chat room, so I don't know what more you want me to add to that, but a similar situation here, you know, hitting some of the stronger levels on the way up and finding a bit of a brick wall. You know, this 122.80 level, you know, it goes back in time. So you can see when we start to hit these bigger levels that the price is not so fast. So that's why I've got that level there. But it's all these dollar pairs, Aussie, Kiwi, Euro, is all looking the same. You know, we've had a trend down. Now we've found a bit of a bottom. Now we're going out the other way, but we're not out the woods yet. You know, this trend here, we don't hit the 38.2 fib until the magic 124.5, 60 area. You know, that big old zone up there. So this trend isn't changing, in my opinion, just yet. At the moment, this is maybe just a dead cat bounce. If we start breaking these levels, breaking that fib, well, then I'll start to believe. But, you know, you want to trade it. So if you want to trade it, then maybe look to buy a break up here, 123, 122.80s, 123. You know, if you get above there and hold it, if you haven't got any position in this one, if you didn't get long in this and missed it, well, fine. You can take your cues maybe off two areas. 122.60s. You have a little tight long off of there, tight stop in case it doesn't hold, because it's only a real short-term level. And maybe get the springboard, but you've only got 30 pips to play with by the time you've factored in spreads. So if you get 10, 15, 20 pips in the green, you need to be taking some off and protecting the rest. Or you wait, break 123s, wait for a retest, try that, and then maybe you get the springboard. So you can trade these slow markets, but you've got to have patience and you've got to pick your levels. Because there's no point jumping in here at 122, 70s, 80s and thinking, right, I'm going to buy it, because you're messing around in a real tight zone. So have patience, or wait for a bigger dip, but then maybe you get scared if you get a bigger dip, because you think, okay, what's happened here? We've come all the way back down to 122s, 121 and a half. What's gone wrong? And now all of a sudden, while it's at 123, you want to buy a dip. When it's down here, you think, well, do I want to buy that dip now? So this is where the psychology of trading comes into play, because you can have your mind changed in an instant. That's why you trust your levels. If you've been waiting for a dip, well, you get a dip, move to 121.50, there's your dip. How you trade that is down to you. Do you try a tight long, or do you think, no, I'm going to buy it from there all the way down to the lows and then hope for a bigger move up, a secondary hold, a double bottom to form, and then a secondary move up that might kick us up there. But in the meantime, yeah, just go with the flow, go with the price action, and see what happens. Horatio, what do I think of Aussie dollar long on a weaker CPI? Are we past China pessimism? I'm going to assume are we past China pessimism? Yes, I think we are past China pessimism. I think we've been past it for a couple of weeks now. We were monitoring China when they were easing and looking at rate cuts, and the market was reacting in the natural way that it does when a country or economy is easing. It was seeing the currency weaken. But then we got the flip, and the flip was when the market suddenly thought, well, hang on, this easing is actually designed to fix the issues in China. Now it seems more positive that they're doing something about it. So now when we see further easing news, like the fiscal stuff we had earlier this week, the one got bought, because it was the market saying, yes, we're seeing that they're actually going to try and fix this thing. And the data's starting to show in a tepid format that it's responding. We've seen better PMIs over there in China. So, yeah, so it's Aussie dollar. It's going to be a bit of a risk play in terms of PPI. It's the same as all the other pairs. These moves, if I took out what asset this was, it could be cable, it could be euro dollar, it could be Kiwi. It's all going to move the same way. But it's going to be a question of speed. Again, we're in a bit of a shallower downtrend. We found a bottom. It's looking at this one looks slightly different to some of the other pairs, because we had a sharp move down and then it's been grinding lower since. So although we've got a bit of a short-term bottoming play and a pretty decent bounce, we're not breaking out of that trend just yet. So we need to get above this area. Will be my pick, 65, 20s, 40s. Get back above that, then I'll be ready to confirm that this is a bottoming play. But until then, I'm not sure it is. It might be, but I'm not sure. I don't have conviction that it is. But if we get a break above there, then I'll have great conviction that we're turning around at least this part of the trend, which if we go a bit wider, is part of a bigger move down, which has been a bit messy. But again, you can look at this similar price action here as we're getting here, okay, where it's just not doing anything, but it's just edging down, and then we get a bit of a bounce, and then the trend resumes. So this one, yeah, definitely not looking like we're breaking the trend quite yet, but there's plenty of pips to be made trading these moves anyway. So on the PPI numbers, again, strong numbers. You're going to see a dip in this. If you don't believe that dip's going to last, well, then pick where you want to buy it. If you get a dip, you know, 63.5, probably a bit of a push for that number, but dip down there, that's going to look very enticing for buyers. So if you're not in a trade already and want to be long, that's where you want to get in. If you want to get in short, then you perhaps want a week's number. Maybe we're going to move up to 65. I expect we'll get a bit of traffic before we get to 65, so 64, 80s, 90s. So if you want to get on the short side, that's your technical area to look at. Above 65.40, something's probably changed. And then maybe you get a bit of range play going on. But again, let us know what you're doing. I'm taking Horatio that you're thinking about an Aussie long. So, you know, let us know what levels you're looking at. Where are you looking to get in if you're not long and wanting to pick a trade? Ali, I'm not going to talk about tomorrow's UK data, or I have nothing to talk about tomorrow. So we'll save that one for tomorrow. Right. Nothing much else I can talk about. It's really it's a bit disheartening because obviously we want to give you some good ideas and you know, talk about markets moving and what's next and where we're going. But you know, there are times when you just have to sit back and put your feet up and you know, think about what you need to do next. You know, pick your levels, know where you want to trade, and just sit back and wait for it. Don't go rushing in to something stupid. Anyway, we shall call that a day. Oh, Horatio, you was waiting for a break above 64. Yeah, so it's again, it's not looking all that decisive, is it? You know, again, this is again a bit similar to the 106, 10, 15. You're getting the moves above 64, but then it fails. But it's looking a bit more supported now. So, you know, that's 64 is your level. You're getting a bit of a step up, 64.10, but you've got to take out these highs. If you can't take out these highs, if you get them another move up here and it falls short, you know, 64.30s, then you've got to think maybe you've got a bit of a top in play and maybe it pulls back. Anyway, thank you very much, everybody. Get those questions ready for tomorrow. Sab, I'll look at pound Swiss tomorrow, seeing as Alice highlighted we've got some data out. Let's have a look what data it is. GDP numbers, monthly GDP numbers, and we've got industrial production. Okay, so we'll look at that tomorrow for you guys and girls. Have a great day. Stay safe over that PPI number. Hopefully you got yourself set up and ready to know what to do with it. Have a great day. We shall see you all tomorrow.